Good morning, everyone. Welcome to our seminar on how to analyze your financial statements. Just so everyone knows that we are recording this and everyone will get a copy of this by email along with our PowerPoint presentation at the end. If you have any questions during the seminar, please feel free to type it in the chat box or in the question box. We will get to it as soon as we can. If it's during the presentation, we will. At the end, we've set aside some time to answer any questions. Or while we're doing the presentation, if we notice it, we will try to get to it. My name is Daughton. I'm an audit partner with Dannible McKee. I'm also a certified forensic examiner, and I've been with the firm about 25, 26 years. And this is one of our other partners.
I'm Kevin Didio. I'm an audit partner at Dannible, CPA, and also a certified information systems auditor. I've been working with companies in the audit and accounting field for about 10 years. We got a really good presentation for you here today and excited to be here.
So this is what our agenda is going to be. I'm going to go through the beginning parts. And when we sat down to look at the webinar, we thought it was really important to really go through some financial statement basics. So for anyone who might feel this is a little redundant to them, I apologize, but we felt it was a really good starting point to make sure we understood all the main parts of the financial statement before Kevin goes through and starts going through the next section, which is going to be the analysis, and then really utilizing the financial statements to track the company's performance and some best practices also that we've seen. So on the financial statement basics, what is its purpose? The financial statements provide critical financial data to stakeholders for assessing a company's health and performance. Who are the stakeholders? When we sit down to plan and prepare an audit, we think about that. Who's the users of the statement? So is it the owners, the managers, the creditors, investors, even government agencies? We have a lot of nonprofit entities on this webinar today. Or it could even be vendors who want to see your financial statements, bonding companies if you're a contractor. So those are the stakeholders of the financial statements. So we're going to list out the main financial statements. And again, we're going to break it out into profit company and nonprofit companies. And one of the things I always do on my boards when I'm presenting their statements is there's a lot of board members who are in the for-profit space. So we sort of just show this out. So for profit companies, a balance sheet. If you're in a nonprofit company, it's a statement of financial position. They really mean the exact same thing. It's a snapshot of your assets, liabilities, and equity at a specific date. So for profit companies, typically that's going to be a December 31st. Nonprofits could be any time, December, June, May, just depends. And if you're doing them internally, it could be for a month then. Next is the income statement, or for nonprofit companies, the statement of activities. Shows the financial performance over a period, details out your revenue, your expenses, and your net income. You also refer to it as P&L. Next, statement of cash flows, called the same thing on nonprofits, and it tracks your cash flows that are coming into the company and how you're spending them. And then statement of owner's equity, details the change in the equity of the company. And then nonprofits have one additional statement, which is the functional expenses, and it details expenses into the various categories. So here is a balance sheet. So the first one we're going to look at is a wholesaler, and you'll see the top section are the assets, and then we break the assets out into current assets and long-term assets. How do we determine that? Current assets are anything that can be liquidated into cash within the next 12 months. And we start with the order of liquidity. So cash obviously can be converted to itself, so that's first. Accounts receivable, inventories, prepaid, stuff like that. Here's your total current assets. That's going to become important when we get to Kevin's ratio analysis. Investments really depends on what management's doing with investments, where they're classified, but in this case, they're long-term. And then some fixed assets. Next section is liabilities and stockholders' equity, and it's the same thing. Current liabilities we start with, And we normally list these out based on security that's involved in the company. So if you have a line of credit, that's usually gonna have a UCC filing, that's gonna be the first item that would be paid. Next, customer deposits, current portion of debt, and then you have your unsecured liabilities, accounts payable and accrued. Giving you total current liabilities, some long-term debt, and then equity. The next financial statement is manufacturers, and you'll see it's very similar. The only other thing we added to here, if you look under property and equipment, is the operating lease right of use asset. And that is that new pronouncement that came out a few years ago. Next is goodwill, if a company had goodwill. Next, balance sheet, construction and A&E entities. You will see retainages on contracts, costs and estimated earnings. And then in the liability section, there's billings and excess. So those are really the only differences between all the different financial balance sheets. Then we have the nonprofit. Really, again, same thing. The only thing you might see are grants and grant payables. Everything else, other till you get to the net assets, are similar. Then in net assets, you have to list out if it's donor restricted or net assets without donor restrictions. Next statement, income statement. Again, this is a wholesale. We won't go through all these in full detail, but you have net sales, your cost of sales giving you a gross margin. They're all going to be pretty similar. It's really imperative that each company makes sure your costs are getting allocated to the right section. So if it's a cost that's used to make a product, to sell a service, those all should be in the cost of goods section. Then you have selling, general, and administrative, which gives you your income before other income. And then you have some miscellaneous income and expenses, which would be interest, expense, income, gain or loss on sale of fixed assets, stuff like that would go in there. Then you get your net income before any taxes. If you were a tax-paying entity, you would list that out. If you were a C Corp, you'd have deferred taxes in there. And then for states like New York, and there's a bunch of other states, there's a new thing called PTET, which is a pass-through entity tax. You would show that, and then show your consolidated net income. Manufacturing, again, same thing. The only difference, you'll see cost of sales in a retail environment, cost of goods sold in a manufacturing environment. No difference. Construction, you're going to see revenue from construction contracts, cost of those contracts, so forth. Again, no significant difference other than the nomenclature. Where we do get a little different is nonprofits. So you have to list those out with donor restrictions and without donor restrictions. So if you do a capital fundraising that's specific for a new roof for the church, that would be donor restricted. Versus a general donation that would go into without donor restrictions. And we have to make sure, and you have to make sure as well, that you're spending that money in accordance with the donor's wishes. Next statement, cash flow. Underutilized statement, not a lot of people really understand it. And we could do a whole webinar on it. But ultimately, this is a great statement that's utilized where your cash is going. In this period, it's for a whole year. But it's really important to look at. So the first section is your operating activities, which is really your daily business operating activities. So it really takes your current assets and your current liabilities and looks at those changes. So as you grow your business, your accounts receivable might increase. If that happens, you're going to use cash to finance all your customers. How are you going to get there? Are you generating enough cash to get by? Next is the investing activities. This purchase and sale of long-term assets. Are you reinvesting into your company, or are you taking money out of your company? And then the last piece is financing. And it's transactions that involve equity and debt. So if you've borrowed on your line of credit, you've repaid long-term debt, that would show up there. And that would then bring you to your cash on your balance sheet. Owner's equity, again, just rolls forward all the changes that happens in the equity section on the balance sheet. If you bought or sold common stock, any additional paid in capital, if you have other accumulated comprehensive income, and then gives you your total stockholders' equity. And here's the last statement that is used by nonprofits. So you'll see they have to break that into the different programs. So there's management in general, fundraising, to give you your total expenses. So for example, salaries and wages of the 500,000 would have flown up to the earlier income statement or statement of functional expenses on your income statement rather. So this just breaks it down into the various categories. And now I'm going to let Kevin start his presentation, which is probably what everyone's jumped in for. But
Thanks. So now that Sean has kind of established a baseline for the financial statements, going through each one of those and kind of explaining what they show, what we're going to do is we're going to dive into a bunch of different ways you can analyze your financial statements. And listed on the screen here, we'll go through each one. They're all great ways to analyze your financial statements. Depending on your current situation and what your company's trying to do or what you're trying to track, some might be better than others. So hopefully you get some insights as we go through those. So the first one is, you can just look at your basic financial statements, what Sean went through, your 1-year financial statements for your balance sheet, income statement, and cash flow. For your balance sheet, you can assess liquidity, solvency, and the capital structure just by looking at it. The income statement, you can analyze your profitability, your revenue trends, or even your cost management. And then as Sean mentioned, on the cash flow statement, you can evaluate your liquidity, your financial flexibility, where you're using your cash and where you're bringing in cash. So that's the first way. And we're just going to get more and more detail here. So the second way you can analyze your financial statement is by comparing one period versus the next. So on the screen, you'll see a balance sheet that's compared current year versus the prior year. And then the third column there will be the increase and decrease based on year over year. And if you look at the assets section, you'll see, okay, assets went up by $8 million. Why did that happen? And you'll see highlighted there, my inventories increased by $5.4 million. So part of this exercise would be, were you expecting your inventories to increase that much? What activities did you do throughout the year that might have accelerated those inventories? Was there a softening in demand where maybe you have inventories sitting there longer than they usually are? If we move down to the liabilities section, you see the total liabilities increased by 5.1. And the big driver there was customer deposits. So if I look at this, it's kind of telling me a story that, customers might be putting orders down and giving us a deposit, and we're not getting the inventory out fast enough. So that's the second way is flex analysis year over year. This is just a balance sheet. You can also do it on the income statement. So this is an example of an income statement, flux year over year. Here we presented 5 years in a row, just to kind of see the trend. And if you look at, say, interest expense line, you'll see that interest increased at a steady pace up until prior year 2, and then it kind of ballooned. So what activities is the business doing to make the interest expense bigger? Is it the interest rate? Is it, did we go out and get a loan? So just taking a look at that analysis and make sure that the activities within your business actually match what's going on your statements. So this is another financial statement analysis. It's a flux again. What we're comparing here is our actual to our budget or our plan. At the beginning of the year, we put a budget together. You know, where do we expect to be for sales, for cost, et cetera, et cetera. And then tracking that on a monthly basis. Where did we land this month? Where were we supposed to land? What's the difference? What's driving those differences? And you can do that on a top level sales number. You can do it on your cost. And you can do it on pre-tax profit. All great exercises. And then this is even more detailed than the income statement. This is actually breaking out your expenses by big category and comparing actual to your plan and kind of seeing, you know, are your expenses coming under budget? Are they coming in over budget? You know, maybe you have some labor that's coming in unfavorable, meaning we're spending more than we actually planned to. Why did we do that? Was there a shift in the plan? Did we hire more people? Are more people working overtime? So kind of looking at those items across the board on an expense level makes it really helpful to kind of forecast where you're going to be for the end of the year.
A question I get all the time, and I'm not sure your opinion is, if the company goes out and acquires another division, another entity, would you go ahead and update your budget?
Absolutely. You got to keep your budget flexible. You know, if you have big changes, work on that budget. You know, what a lot of companies that I see do is they'll have their annual budget and then they'll also have a forecast. And what the forecast will represent is the actual to that period, and then what they're forecasting for the rest of the year. So if there was an acquisition or if there was somebody, or they were hiring additional people, it would be reflected in that forecast. That's a good point, Sean. So now we're going to dive into financial statement analysis, looking at ratios. So using your balance sheet and your income statement and your other financial information to come up with ratios. The purpose of this would be to utilize financial ratios to gauge various aspects of the company's performance and health. So some of the key ratios can be broken down. Liquidity ratios, so that'll be your current ratio, quick ratio. We'll go through them on the next slide. But what liquidity ratios measure are how the current assets are going to help you meet your current obligations as they come due. Profitability ratios, they basically assess the efficiency of generating profits through your resources. And then your solvency ratios evaluate your long-term financial stability and debt management. So just to dive into liquidity ratios a little bit more, you have your current ratio, quick ratio, accounts receivable turnover ratio, and then your accounts receivable in number of days. So as you work down and across, it basically explains what it's measuring. So your current ratio is measuring the company's ability to meet current obligations as they come due. The way that you would calculate that is you go to your balance sheet, you take your current assets, and you divide it by your current liabilities.
Yeah, that's, you know, just to jump into, that's a heavy ratio that financing institutions absolutely will look at when you're going out to get new financing. Or if you have ratio covenants on any loans you have, they're going to be looking at that current asset versus current liability. Again, how quick can you convert that cash? And typically it's going to be at least a 1.2 turnover for sure. Yeah. I just wanted to throw that in.
So the quick ratio is pretty comparable. You are kind of comparing your current assets to your current liabilities, but you're taking out any inventory that you might have or any unusual other current assets that you have. So you're really kind of taking your cash, marketable securities, and AR, which are kind of those three assets that you can convert to cash really quickly to meet future obligations. And then your accounts receivable turnover. So this is measuring the number of times trade accounts receivables turnover during the year. And you would measure that by sales divided by accounts receivable. And you could further quantify that by dividing that by 365 days. And that basically is going to tell you the number of days it takes for a trade accounts receivable to turn over. So you make a sale, you provide an invoice to a customer. How many days does it take to get that invoice paid by the customer? Moving on to profitability ratios. So these are really kind of three big ones that everybody's looking at. You get your gross margin, operating expense divided by sales, and then your operating margin. So your gross margin is measured in the profitability of the company's core operations. So you're basically taking revenue minus your direct cost and dividing it by revenue to come up with your gross margin. And then just skipping down to the operating margin, you're going to take your net income and divide it by your revenue. So you're including those indirect costs, those SG&A costs. And then the middle one, operating expenses divided by sales. You're measuring the operations financial efficiency to show how much you generate income. And that'll be your SG&A divided by revenue. And then we have one solvency ratio here. It's debt to equity ratio. You'll see the balance sheet here. It shows how it's calculated. And what it's calculating is equity and debt. A company is using to finance its assets, providing insight to financial stability.
Another key ratio financing institutions love.
They love this one.
And real quick on the gross margin ratio, if I could just, I had a recent example. It's really hard to move gross margin percents, right? So that's a great ratio and hopefully everyone's utilizing that. But in one of my clients, their margin was down about 6% and they were unsure why. So after doing a lot of digging, we figured out some costs from fuel were getting increasing dramatically on a trucking company. And they weren't passing that along to their customers. So, everyone should be looking at these types of ratios all the time.
And I think what you're talking about is kind of presented here, right? What Sean was talking about is he had a client that had a gross margin who changed pretty significantly year over year. So if you look at here, this is a flux analysis of those ratios. A company is comparing their ratios on a 5-year basis, and then you'll see that gross margin, right? It's typically staying, around 28 to 25. You wouldn't expect it to jump much more than that unless there was some kind of significant unusual event or something's going on in the business that they need to look into more.
Yep. It's just a tool to help you look into things more when they're out of that normal piece.
Yeah, and this is really another great way to kind of analyze your financial statement on a year-over-year basis. It gives you a general sense of how the company's doing on a trend analysis, because you're looking at 5 years of data and you can kind of compare that 5 years of data against each other to see where you're headed. So now we're going to talk about using your ratios and your financial data and comparing it to industry. This is very beneficial. Some of the benefits are identifies best practices in areas that need improvement. It's important in goal setting and performance and reviews. So, one of the industry benchmarks that we use for clients is RMA. And it has so much information, by industry that you can go and get, and you can compare it to a company that you're working with, and you can say, in industry, we see a quick ratio that's X, and you're trending around Y. Why is that? What's going on there? And right here, you'll see it's the same graph as before, where the company is comparing their 5 years of data for each ratio. And then at the end, you bring in the industry standard. So if we look at, we look at gross margin, for example. You know, our 5-year average is 26, industry standard is 28, right? And it looks like, you know, over a 5-year period, we have trended in an upward direction, right? We went from 25, 27 down to 25, back to 27, 28. So we're pretty good with the industry standard. We're pretty much in line with them. You can also look at maybe days receivable, right? On a 5-year average, we're collecting on our invoices in 41 days. The industry standard is 42. We're a little bit better than the industry, but it's a good indication that everything that we're doing is in line with other companies in our industry.
And sort of on this slide too, Kevin, just to point out, you know, drive home the gross margin, looking at prior year 4 and 2, at 2% decrease in gross margin. If you had a $10 million revenue company, that's a big number, right? It's only 2 percentage points on here, but you multiply that out by $10 million or $20 million in annual revenue. That's a big number that's not going down to the bottom line.
Okay, so now we're going to move into doing financial statement analysis on key performance indicators, abbreviation KPI. This has become more and more popular amongst companies. It really identifies on an industry basis or a department basis, you know, a measure that we should be tracking on an ongoing basis. It's important to note that it may or may not be financial data. And then we have a chart to the right here that kind of gives you a guideline of what a KPI should be. It should be specific, measurable, achievable, relevant, and time-based. So we're going to dive into some, I guess, more known KPIs that people are tracking. A lot of companies that I have, they have actual KPI dashboards along with the financial analysis that they do. So they're kind of looking at both hand in hand. So let's dive into it.
And again, I'll just reiterate that the slides and the recording are going to be available to everybody at the end of the seminar, because I know we've had a few questions.
Yeah, so this will be a great resource for you if you're considering incorporating some KPIs into your monthly analysis or your annual analysis. So these KPIs are based on department. It doesn't have to be company whole. The first one we have is financial KPIs, and we'll dive into those ones a little bit more specific on the next slide. But they can measure liquidity, profitability, solvency. Then we have sales KPIs, customer life value, and customer acquisition cost. So what these are measuring are, you know, it's really what are the inside sales, external sales, marketing costs that we're incurring to bring on new customers? Or what is, when we get a customer, what is the lifetime value? Like how many times are they coming back to us? Marketing KPIs, they might be website traffic, social media traffic, conversion rate traffic, content, which might be, you know, somebody comes to our website. How often are they going to make a buy when they come to our website? Again, these are probably non-financial data key points, but also great to track. And then we have employee KPIs. So that would be number of overtime hours and turnover rate. Customer KPIs, a customer retention rate. You know, we get a new customer, they're coming back to us, or a customer satisfaction score, which again, non-financial data, right? You're not getting this stuff off your balance sheet and income statement. You're probably sending out a customer survey and evaluating how you're doing. So we're going to jump into the top one, financial KPIs first. Some of these are a little bit repetitive than what we already went over, but it's a good indication that they're pretty important benchmarks. The first one is gross profit margin. That'll be calculated revenue minus cost of goods sold divided by revenue. The second one is net profit margin, which is net profit divided by revenue. Again, these two were kind of already covered, but you know, very, very important key benchmarks to be tracking. The next KPI is production cost analysis. So this will be probably more geared towards a manufacturing company. You're going to look at your total production cost divided by the number of units sold. And you can track that on an ongoing basis to see, how much is it taking to create one unit that is going to be sold? Is it trending upwards? Is it trending downwards? And why might that be?
So the year-over-year analysis is really key. So that, for sure, that would have caused the fuel increase.
Mm-hmm.
Realizing why that changed so dramatically.
Yeah, and a lot of these, it depends on the company, right? Maybe you want to track it on a year-over-year basis. Maybe you want to track it on a quarterly basis. Maybe you want to track it on a monthly basis. Another key point there is you have to have access to that information in order to evaluate it. The next KPI from a financial perspective is customer service cost. So that'd be your total expense divided by your total customers. And then the last one there is EBITDA, which will be your net profit. And you're going to add back your interest, taxes and depreciation, and amortization to get your EBITDA.
And again, since we're looking at statements as well, there's a lot of people that are looking to transition out of their companies, sell their companies, sell it out to private equity firms. EBITDA becomes a huge calculation.
Yeah, EBITDA is that big point for even like internal transitions and external sales as well. That's a big benchmark. So now we're going to transition to KPIs, and we're going to make it a little bit industry focused. We're going to go through the retail, construction, manufacturing, and non-for-profit. And because the companies have different accounts, there's different KPIs that are targeted for each one. So retail, wholesale, inventory is huge for them, right? So that inventory turnover, which will be your cost of goods sold divided by your inventory value, is a KPI. Lead times, how long does it take for us to purchase? We contact a vendor, we put in an order. How long does it take for us to receive that order? And that's very important when you're trying to manage your inventory and keep your inventory lean to open up cash flow. The next one is shrinkage. So that's inventory book value minus inventory actual value. What you're measuring there is probably loss of death or
that's a key area that I come in and look at as a fraud examiner.
Right.
Is the shrinkage number and the gross margin. If I've told you the amount of companies that have had employees that have helped themselves to the inventory, created their own eBay businesses on the side, it would be, it's many. So looking at that is a huge item that people in that space need to look at.
Mm-hmm. The next one here is the conversion rate. So this is really kind of that marketing one that I already discussed. Your total transactions versus your total visitors. It could be based on a retail store. It could be based on your website, either way. And then average transaction value, which will be your total revenue divided by your number of transactions. So that's for retail, wholesale. The next one we have is manufacturing. If you think about a manufacturing company, we got a plant and you're making something. So a lot of these KPIs are kind of focused on that manufacturing process. Labor cost per employee, big KPI. It's your total labor cost divided by your number of employees. Revenue per labor hour, total revenue divided by total labor hours. And then your efficiency of utilization, that would be production hours divided by total hours. And those first two really kind of measuring your labor cost. Keep an eye on your labor cost. It's a lot better than just kind of tracking a dollar amount of how much you're spending on labor. It makes it so like if your employee headcount is going up and down, you know exactly what you're looking at.
And one just thing I'll add is through COVID and then the earned or employee retention credits, just because you have a number and it's going down, you have a lot of excess labor costs. doesn't give you always the full story, right? So it's just, these are just guides and tools to really help them.
The fourth one here is the absorption cost. So this is really focused on the manufacturing process. It's actually a managerial accounting concept. So that'd be direct labor plus direct material cost plus variable manufacturing overhead plus your fixed manufacturing overhead divided by the number of units. And this is one that you really want to track over a period of time. It measures the efficiency of your manufacturing process. You know, if the number goes up, you know, did you have some downtime during the period where machines were down? Did you have some labor issues? Did you have some order issues? This KPI will really bring that out. The last one is cash conversion cycle. So this is really looking at your average inventory days, your average receivable days, and your average payable days. How many days does it take to collect on a receivable? How many days does it take to pay a payable? Really kind of focusing on these numbers to see how cash is turning over, so you can use it in a future period to buy more inventory or to along those lines. The next industry is construction KPIs. So really kind of focused on the project as well as labor for construction. The first one is planned hours versus actual hours. Probably non-financial data, but also great to track by project specifically. Percentage of labor downtime, that'll be downtime hours divided by total hours. Scheduled performance. So how are we doing? We create a plan to complete projects on time. How are we doing with that plan? How are we doing with scheduling? A lot of times when projects, construction projects get delayed, it damages you because those people can't go work on a new project. But delayed projects typically mean more cost for you. So you need to kind of reevaluate, and the next KPI goes into that, your cost performance of measuring projects within their budgets. And then the last one here is equipment utilization. So just taking a look at the equipment that you have on your books, you know, is it being used? Is it just sitting around? And this is a good KPI for when you go to evaluate, you know, do you need to buy new equipment? Is the equipment that you have not being utilized because there's no projects that it's on, or is it not being utilized because it's always down? It always needs repairs. And then these are your non-for-profit KPIs, your donor retention rate. So that'll be your current year donor list, and then comparing that to your prior year donor list. How many people are coming back year over year to provide donations? Your fundraising efficiency, that'll be your total contributions divided by your fundraising expense. So kind of what is the return on having a fundraising activity?
Are you spending all your money in the right place and your time and effort
Right.
at fundraising to make $2,000?
Right. Yeah.
It's a great one.
The next one is your overhead rate, is your total indirect cost divided by your direct cost. And then your donor growth. You know, is your donor pool growing year over year? Is it going down? Why is it going down? Why is it going up? And then program efficiency, which will be program expenses divided by total expenses. So that's KPIs on an industry basis. You know, if you have any questions on any of these KPIs or any of the financial statement analytics stuff that we went over, feel free to reach out. We have a few case studies here, pretty simple ones, but we'll run through them quick. So in the prior year, the company obtained a revolving line of credit to help build inventory levels as demand for products increased. In the next 12 months, management is expecting a slowdown in orders due to lower level of consumer demands. Management wants to track its inventory levels to understand if free cash flow should be used to restock that inventory or to pay down the line of credit. So some of the things that the company should probably do, they can create a dashboard. They don't have to create a dashboard. It could just be an Excel sheet. And they would monitor at least these 4 things, right? Inventory balance by inventory product. How is it looking month by month? Your inventory turnover. You also want to look at purchase and lead times. To restock my inventory, does it take a couple of days or does it take a couple of months? If it takes a couple of months, maybe you want to be a little more cautious with you want to be a little bit more cautious. You want to have that cushion in your inventory balance in case a big order comes in. And then you'll look at your rolling sales by inventory product. And what you can do is you can compare those sales to the inventory numbers to basically forecast what you should be purchasing over the next, couple of months, and what might be left to pay off that line of credit. The second case study we have here is Company A is currently in a marketing campaign to obtain new customers and grow top-line revenue. How would the company track its performance of its marketing effort? So the company could look at advertising cost on one line and then put sales transactions in dollars on the next line and compare that on a monthly basis. As our advertising costs go up, do we see our sales transactions going up? Or do we see them kind of staying still? Or maybe there's a lag, right? In January, we have big advertising costs. In February, we see the sales transactions going up. But this will also help you evaluate your marketing efforts, right? Did you do a marketing campaign on your website? Or did you send out, flyers or whatever you did from a marketing perspective? You can evaluate that campaign versus other ones as well. You can also track new customers by month. The third one here is Company X wants to review its operating expenses with the goal of reducing these expenses to increase its profit margin. The owner communicated the plan to management. How would the owner track management's progress with this? So they create a dashboard where they track operating expense balance by expense category. They can also do a period flux of operating expenses by expense category and basically fluxing those to see what went up, what went down. Another great tool is a comparative size analysis. So you're basically taking all of your revenue or all of your operating expenses by key category, and you'll divide it by a percentage of revenue and basically track that percentage period over period. And the last one here is a little bit more obvious. You would track your net profit margin. The last case study we have for you is management of Company X wants to perform a study to ensure cash flow is being maximized. One item the company could track is receivables and payables agents. So you have your average days receivable. There's a calculation there. We went through it previously. And then you have average days payable. What the company would want to do is decrease its average days receivable and increase the average days payable in order to maximize cash flow. So the company has direct control over their average days payable, right? You get an invoice from a vendor, it's up to you when you're going to pay it back, right? A lot of terms we see are either 30 days or 45 days. If you're worried about cash flow, make sure you maximize that. Make sure you look at that because there's no reason to pay a vendor in 10 days if you don't need to pay him for 45 days. Sure. On the receivable side, there's certain strategies that you can have to get paid faster, right? You can offer a discount. If you pay in 10 days, we'll give you X. Or you could do it another way where terms are 30 days, but there's a fee if you go after 30 days. So that kind of keeps your customers, and you're talking to customers here, right? So you don't want to make anyone mad with your terms or anything like that. So be cautious there. But these are just some of the strategies that you could have to very simple to just try to manage your cash flow and have more cash flow available for your operations. So now we're just going to cover best practices in terms of generating and distributing financial statements or maybe financial analysis that you have done. It's important to think about who needs certain information. Somebody on the line in a manufacturing company might not need to know what gross margin is, right? But he might need to know, number of overtime hours, or he might need to know something along that lines. So really kind of think about that. How often does it make sense? Does it make sense to provide an analysis on a monthly basis? Does it make sense to just offer it on an annual basis? So really kind of thinking about those items as you're kind of coming up with ways that you want to analyze your financial statement and distribute it to people in your company. Another good point that I have is, take a look at your financial system. Is it easy to pull data out of there? Is it hard to pull data out of there? Is it hard because the system's clunky, or is it hard because you don't understand the system? I think every company should have QuickBooks on a baseline, right? And it's fairly easy to pull financial data out of QuickBooks on an on-demand basis. So if you're having trouble with that, reach out to us because we could help.
Yeah, for me, the key is to do something, right? So we have companies who don't do anything, or for the companies that do stuff, they submit the statements and ratios up to the owners who are so busy they don't have the time to look. And they don't look till they have no cash, and they don't realize the receivables went from 32 days to 70 days because their accounts receivable clerk is out on maternity leave or something.
Right.
So to look consistently is really the key, even if you start a basic ratio analysis and then build from there, but to make sure you allocate that time every month.
Right. So that concludes our presentation. We'll open up the floor for questions. I think there's a chat box.
And again, if I think we've already answered the ones that have come through. But if you have any questions after, again, feel free. Our contact information will be on the slides that you'll be emailed. We'll also email you a copy of the recording. Anytime you have a question, send it out to either Kevin or myself, and we'll make sure we get you the answer. Great. We thank you for your time. We hope you learned something from this webinar, and hopefully we'll see you on the next one.